Hi, everyone. My name is Kris Ferranti. I'm a partner in the real estate group at Shearman. I have the great privilege of moderating a distinguished group of panelists who I will introduce shortly. We will broadly cover U.S. real estate investment trends by global institutional investors. We will dig into some of the main topics like inflation risk, migration trends, the remote work phenomenon that we're seeing, industrial logistics versus retail, niche and specialty areas like life sciences that we're seeing really take off. And if we have still time, we'll also cover ESG considerations and distress opportunities. The discussion will span about 30 to 35 minutes. We'll then move into a Q&A segment for the last 5 or 10 minutes. Audience members, you can submit questions at any time using the Q&A chat function at the bottom of your screens. I'll do my best to raise all questions during the Q&A segment at the end. Before we get started on the discussion, I'll let each of the panelists just quickly introduce themselves. So first, we'll start with Erik Horvat from the Olayan Group.
Hey, everybody. It's nice to meet you. Kris, thanks for hosting. So I run real estate in the Americas for the Olayan Group. The Olayan Group, for those of you who don't know, is a family-run global investor and operator. We have had offices in New York City since 1971 and are in other countries as well. The portfolio spans between funds, entity-level investments, direct investments, so pretty wide-ranging in structure and in asset class. And prior to Olayan, I led real estate for a company called Fosun, their U.S. office, the redevelopment of the World Trade Center when I was at the Port Authority, and Northeast operations for Lennar Urban.
Great. Thanks, Erik. Next, David Hamm from Wafra.
Hi, everyone. I'm David Hamm. I oversee real estate acquisitions at Wafra. I joined here in September after about 20 years at REEF. Wafra is wholly owned by the Social Security System of Kuwait. We've got about 28 billion of assets under management across 3 verticals. We've got an alts group, a securities group, and a real estate group.
Great. Thanks, David. David Roll from Norges Bank Investment Management.
Yeah, David Roll. I oversee acquisitions and asset management for Norges here in New York City. Norges is a sovereign wealth fund of Norway. It's a $1.4 trillion fund, predominantly investing in equities and fixed income, about 5% in real estate, which for a large fund is kind of something. And we focus on office, retail, and logistics globally.
Great. Thanks, David. And last but certainly not least, Marcella Fasulo from Cushman and Wakefield. Marcella.
Hi, so our team focuses in New York mostly. I focus a lot on offshore capital on typical, week or year. I'm traveling, speaking with our colleagues around the world and, going to see our clients and speaking with our clients. And, since the pandemic, we've been focusing a lot more across the US, but New York is still our bread and butter.
Great. Excellent, thank you. Let's now get started. So I want to start the discussion with inflation risk. So high inflation, of course, would be very detrimental for the broader economy. The Consumer Price Index, one of the most closely watched inflation measures, rose last month by the most in 13 years at a year-on-year pace of 5%. But many in the investment community feel that this sharp rise is transitory. As one example, I think we're now seeing the price of lumber actually seem to come down as sawmill production has ramped up. Marcella, at this time, how concerned are you about inflation? And what are some of the red flags or indicators you're watching? What are you telling your clients?
Yeah, sure. So, and it's certainly sector by sector, and specifically looking at New York, you can see how the inflationary cycles have impacted it and how it's always kind of risen above. And I'm certainly not a monetary policy expert, but yeah, I've seen a lot about inflation being transitory, and we'll see what happens. For example, in industrial, some of these post-pandemic effects and some of the severe weather effects have been, pretty interesting to watch. And, for example, with the cost of goods being so high, it's very difficult to build, new industrial facilities, et cetera. A petrochemical plant closed in Texas, one of the only two. As a result, there's not enough roof membrane for industrial facilities across the US. Therefore, a third of the 300 million square feet that's being built, is unfortunately on hold. And there's so much tenant demand for a lot of this, space. And so some investors are looking at 15% rent growth for industrial, for example. And so groups like USAA, for example, have 0% vacancy within their portfolio. So you're seeing, some of the pandemic effects and some of the, consumer goods effects really impact rent growth. And that, is certainly positive for owners, difficult looking forward on how you can underwrite. There are also groups that are looking at office right now and office product and thinking that it is, undervalued as compared to a lot of the industrial product. And then you're also seeing a lot of, folks that are taking advantage that are at the top of the K. For example, 10 billion of condo product was sold last year in New York, and $1 billion of that was at 220 Central Park South. So there's certainly a lot of wealth. And real estate, of course, is a great place to put your wealth to be, inflation proof, et cetera. So, for us, and then lastly, it's really interesting to look at hedging costs and how, forward hedging contracts are impacted. We have a German group, for example, looking at an office deal with us. And while hedging costs as of last week were 70 basis points, looking forward for the next 2 years, they're projecting 250 basis points of leakage because of inflation. So
thank you. Erik, David, and David, at this time, is inflation having any material impact on your investment decisions? Is it a factor when you're evaluating investments? Let's start with Erik.
Yeah, I would just say I'm in the process of closing a loan, and we're looking at the price of wood, and it's material. It's happening big price through today. So one of the interesting things is that a temporary moment in time, because wood, as we've seen and read recently, is coming back down. But I don't think it's come through the woodwork yet to recognize it and buy. So we're seeing real time increases in material costs on buys, and the question is, do we wait or do we buy? And that's an interesting, conversation to have. And the second thing is, we've been looking at assets, Kris, that, have shorter term leases, like multifamily with annual turnovers, or things where there's built-in, rent escalation, so that, we're able to manage through that if this continues.
Got it. And David Hamm, any thoughts on inflation risk?
Well, it's changing my strategy on eating out, because I'm definitely seeing it in my food bills. Go out to restaurants, but no, we're watching it, right? And I think the first signals will come from the debt markets, and right now they're relatively stable. I mean, negative inflation news comes out in the press, and all of a sudden rates go down. And you're like, what's going on? So it hasn't materially modified our investment strategy. I think when we think about inflation in the context of an expanding economy, real estate is neutral to benefit, to good in that scenario. To the extent we have negative GDP and inflation, then we're all in a lot of trouble. So I think as an industry, we're generally fine. If you're concerned, you're gonna shy away from long duration lease terms and stuff like that. But yeah, multi-housing, hospitality, multi-tenant office with shorter lease durations, industrial with shorter lease durations, all should do reasonably well in that kind of environment.
David Roll, do you have any thoughts?
No, I think just back to Marcella's point, I think we're really seeing inflation kind of kick in industrial, but not so much in office. And we want to see what happens to the office rents in the cities where we really invest. And we were able to kind of, during COVID, actually take advantage of lower costs, but now we're really seeing the cost run away on everything. So it makes office a bit more difficult to invest in, because the cap rates are actually low because of low financing costs. And then we really don't know what to make of the future rent growth. So it's interesting in office, but very promising in logistics.
Okay, so let's now discuss migration trends. So for the last decade, it seems companies have been leaving the coast in favor of states that can offer more favorable business friendly climate. The pandemic seems to have really accelerated these migration trends. The Sun Belt markets generally have seen an upswing in labor migration, job growth, but there are competing theories. Some have argued that, despite the migratory shifts in 2020, many of these people are headed back to the cities as we move further away from the pandemic. Erik, what are your thoughts on migration trends? Is it impacting where you put investment dollars? Which sectors is it impacting the greatest?
Yeah, migration trends, definitely something we've looked at regularly, to inform the way we're deploying our capital. I think you said it really well, Kris. We're seeing, sort of a desire to be investing in areas where there's relatively low cost of living, lower personal income tax. They're generally less dense, and I mean, frankly, they're just warmer, nicer places to live. So that all got accelerated because of the pandemic, and people are like, well, if I don't have to be in the office, why wouldn't I be in Miami and hang out there for a while? And then maybe they say, hey, look, this is pretty good. And, oh, by the way, I don't have any state taxes, and why am I living in New York? And that's been a conversation. And, I'm a big believer in New York. New York is never going away, but I do think that you've seen a big migration to, out of places like California or New York or Illinois in like the last, year. And you've seen a lot of people moving to the Floridas and the Texas, Georgia, Carolinas. We've been active in the Carolinas and seeing that. So that's been something that's been a trend. And I think the question is that a long-term trend, or, the Florida market has a history of volatility where a lot of have lost on the condo bets that, Marcella is mentioning, and they've made a lot too, but does it become more stable as people migrate and maybe set up satellite offices there? And satellite, not necessarily a bunch of headquarters. So anyways, that's my 2 cents.
Thanks, Erik. Anybody view it differently, or anybody have some additional thoughts to share? Maybe David Hamm, you have any thoughts?
Yeah, I mean, I think it's a trend that's been going on for quite some time, so it's nothing new. It's getting a lot of press for sure.
Right. So
like all things in COVID, trends have just been accelerated to the positive or the negative. I think the interesting dynamic here is that those Sun Belt markets have now gained the attention of a lot of large offshore institutions that otherwise would be focused just on the gateway markets.
Right.
So I sort of joke around saying, the secondary markets are the new gateway markets, and the old gateway markets are now the secondary markets, and we're seeing those the legacy gateway markets having a lot more volatility than some of these secondary markets. But I think what it comes down to, the long-term viability of many of these markets, it's real, but it comes down, in my opinion, to job mobility. And so 10 years ago, if you were a real estate investor and you moved down to Miami, and you didn't like your job, you probably had to pick up your family and leave the market to go get a new job. And now once you have a density of employers in those markets where you have job mobility, it makes those markets much stickier. And I think we're seeing that in a lot of places. It's not just Dallas, right? It is happening to a lesser degree in Miami and Nashville, but there are markets that are really, really heating up, and I think are long-term going to be considered gateway markets.
Got it. Great. Thank you, David. All right, so I want to move on to the next topic, which deals with the remote work phenomenon we're seeing. So just 9 months ago, when we were in the thick of it, surveys showed close to 40% of U.S. companies considered seriously reducing their office footprint. But now with the country reopening, it's been a very different story. I think we're starting to see studies now showing a dramatic decrease in that number, with just 9%, for example, of U.S. companies anticipating their office portfolios will significantly reduce. However, increased remote working trends still remains a top concern in the real estate community. So David Roll, do you think remote work is here to stay? If so, what does it mean for the office sector in the large urban markets? And what does it mean for New York City?
I mean, I think it's here to stay partially. We've started to work. We're going to start to work from home 2 days a week. And then will be in the office 3 days a week, but everyone has to be in the office on Tuesdays and Thursdays. So we're not going to be able to decrease space.
Right.
We're actually going to sublease the floor, which we decided not to sublease because now everyone wants to sit further apart. And we had a pretty dense floor plate, and now we want to have a less dense floor plate. And I think that you have two trends. And one is that maybe people will work from home, so you'll require a bit less space, but then people will want to have more space when they're in the office, and no one wants to give up their desk. So I actually think it's kind of a wash. And my biggest concern is really kind of what Erik alluded to for New York. What happens to taxation policy? Does it become real estate, friendly environment here? And I think that's where we're going to see the biggest impact on the occupiers. And then for New York specifically, there's a huge supply and demand kind of unbalanced at the moment. And clearly New York's going for life science. So I'm interested to see how life science picks up here, and if it's able to kind of serve as what tech did in the last kind of high vacancy period, to come in and fill up some of the supply. So that's what we're focused on for our big office markets. And yeah.
Thanks, David. So I'm interested to hear from the other panelists on their thoughts. Will buildings need to adapt to be successful in this new environment? Erik, maybe start with you.
Yeah, I mean, I think buildings are going to need to, adapt, and this, we talked about this K-shaped recovery for people. I think it's going to apply to buildings too. So if you think about buildings that have fresher air, they have touchless entry, you can be CEO and look at your staff and say, I'm doing right by you. And, you go to your board members and say, this makes sense, for all the reasons, ESG or otherwise, that those are the buildings that will succeed and maybe have pricing power and be able to attract the best tenants at the highest rates. And if you're, some, old building on 3rd Avenue with, disgusting filters, you're probably going to be having a different story, to read. But just on the comment, I just want to say, I do believe, I think they said, less than 35% are back in New York today. But if you talk about a year from now, it's going to be 80% in New York, San Francisco, even these markets. And, there was someone said to me recently that you can have a job on Zoom potentially, but if you really want a career, especially as a young person, you got to be in the office. And, I think for mental health too, I think people discount mental health, and being part of an office and not put away if you don't have a big structure around you, it's good and it's healthy to be part of that. So
yeah. Thanks, Erik. All right, so I want to move on to the next topic, which is on industrial logistics versus the retail sector. So during the pandemic, e-commerce exploded. We all saw that. Industrial logistics gains seem to be in direct proportion to the retail sector's losses. But the emergence of e-commerce sales wasn't exactly a new trend. It was a trend that predated the pandemic, but was greatly accelerated in 2020, as David, you mentioned, so many other trends. More recently, however, the e-commerce share is showing signs of slowing. So as vaccination rates rise, we see foot traffic data now showing more and more shoppers are returning to the stores and malls. So David, Hamm, is there still life in the retail sector? Were we premature again in calling it a retail apocalypse? And in this market, are you more inclined to invest in industrial logistics or retail properties?
Yeah, well, don't forget, we were calling it a retail apocalypse before the pandemic.
I know.
I don't even know what you call what happened to retail during the pandemic.
Right.
I think interestingly, certainly from my perspective, I think I got a lot more clarity on both industrial and retail coming out of the pandemic. I mean, the fundamentals behind industrial are, I mean, they're outrageous, right? They're fantastic. And the ability for continued growth there is you move from, B2C to B2B, it's real. I don't see that slowing down, whatsoever, nor does, 99% of the market. Retail, as we all know, we're over retailed in this country by a substantial amount. And so I think what COVID did is it accelerated the purge of bad retail. So now you you were in an environment where everyone was ordering everything online. So you got visibility into what the ultimate scope of e-commerce penetration may be over the next, I don't know, 3 to 5 years. So you could sort of bracket what that growth expectation could be and how much new supply you need to deliver to meet that. And then on the retail side, you had the survivors, and you had those that absolutely got crushed. And so now you have visibility into which of those centers really are the right centers, which of those tenants really are the right tenants, what is the right footprint, what is the right makeup. And it's just right in front of you right now, and you're seeing it. So I don't believe retail is dead. I believe there's still a lot of challenge in retail, but I think you can pick winners now pretty easily. We just went under agreement on our first grocery anchored retail center last week. So we're sort of putting our money behind that strategy. Very selectively, but no, I do not think retail is dead whatsoever.
Marcella, what are your thoughts? Do you agree with David's view?
Yeah, so I completely agree. And I also think that there are some, conglomerates that have gotten uber strong. And one of them, for example, is LVMH, whose shares are up like 30% this year. And they believe that the future of retail is in stores. And, they're committing to opening up more stores. Target is opening up 30 more stores. Burlington, I think, is opening up 1,200 stores. And then you have all of these other retailers that are starting out of mall or off mall locations like Macy's and JCPenney. So it's definitely, maybe if we're talking about transitory, maybe it's retail is getting a little transitory in terms of how they're testing out, sales. But people have proven during the pandemic that they still have interest in, buying stuff, and they have record numbers of, savings of 2 trillion. So they have to, put it somewhere, and people are probably pretty excited to get out there and start buying stuff in person.
Great. Okay, so I want to turn to the next topic, which is on the niche and specialty areas. So investors spent more than 10 billion on buying life sciences buildings this year, which is twice what was recorded at the same time last year. And last year in 2020, life sciences building sales and refis totaled about 25 billion, which was a massive jump from 2019, which was 9 billion. And then we also have single family rental. The single family rental market has grown by leaps and bounds, and it's attracting some large institutional investors. And the prop tech sector has also made tremendous strides. And you're seeing a number of investors that historically only invested in physical properties are now investing large sums in funds that back prop tech startups. Marcella, do you expect currently popular niche and specialty areas to continue to become more mainstream and possibly result in the expansion of markets and product types?
It's a good question. And certainly there's a lot of demand for niche sectors. And, a lot of that is just fueled by lack of ability to get into multifamily and industrial, which is what everyone has wanted. It's a question, back though, in terms of how much product you can actually aggregate in those sectors, because life science is very cluster oriented. You have San Francisco, you have Cambridge and San Diego, and then you kind of have these secondary markets as well, like New York and like Austin and Houston. So it's, a question mark of what you can get. And then beyond that, it costs so much to build out the spaces for labs and otherwise that, the stars really have to align. And there are very few operators that, are capable of building something that these, companies want. That being said, though, after the pandemic, there's much more demand for it. And then SFR product, the single family rentals, there's so much demand. It's so difficult to get scale. And then you have a lot of operators that kind of are not on the same page of the capital. If you're a sovereign, if you're an institution, you probably want a long-term hold. A lot of these local operators are more interested in, building and selling versus holding. And then prop tech, there are also, then separately going to that one, there's just not that many users. So any of these companies that are, become a unicorn, they become a unicorn because they have, a lot of users. There's just not enough commercial real estate people to populate, that kind of, maybe there is something that's going to revolutionize, the market. And certainly there's a lot of interesting new, technology advances in the last 10 years, but it's difficult to foresee something that is going to become global.
Right, right. So I'd love to hear from the other panelists on this. Were you able to invest in any areas during the pandemic that you couldn't before, or maybe you couldn't today? And if not, would you have invested differently if you didn't have to get it through an investment committee? Let's start with Erik.
That's a loaded question, I think.
It is. You can ignore that one, Erik, if you need to.
Well, I was just saying, Marcella, on your comment, the number of people I've seen bring a deal when it doesn't fit the box, just label it life sciences and say, like, this is amazing. It's scary. And I think that that's a sign that we should all be careful with niche markets for people that do one-off things that they don't maybe fully appreciate or understand. It can be a pretty dangerous thing. So I'm not upset. I mean, look, there's some great sponsors in there that do amazing things, and maybe early on in the pandemic, you could have bought them really well. But I'm pretty good with what we've done. I mean, we, Kris, leaned into existing relationships. I'm curious as to the others, but, it's hard enough to find really great deals and get conviction in a scary moment in time to make big, swings. And so we looked at that with existing partners versus underwriting new partners on top of like the risks of the deal. So, we did a lot in the garden, style home space then, and built that up. And so it was more focused on that versus a niche or specialty area. But no, I don't have any regrets. It's been worked out.
David Hamm, you have any thoughts on that?
Yeah, I mean, I think I've got thoughts on the niche strategies. And I think probably in a couple of years, we're not going to be calling several of these strategies niche strategies anymore. Right. I think that they're great. They're great tailwinds for the single family rental and the life science strategies. I do get concerned with the amount of capital that is flowing in to those strategies and the risk for sort of oversupply in probably not in the next 1, 2, or 3 years, but looking at a little bit further than that. All that capital that's being raised into single family rental development has to get deployed. It has to get built. And if you look at where people can successfully build that stuff, it's in lower cost markets, and they're now even being pushed well outside of the city limits of those Sunbelt cities. And so we're just going to see a lot of supply deliver, and we'll just have to see if the market can absorb all of it. The life science trade is interesting. I agree. There's a lot of deals are being billed as life sciences that are clearly not life sciences. A lot of markets are trying to position themselves to be life science markets that aren't life science markets. These are very expensive build outs with often non-credit tenants. So I think there's a fair amount of risk behind that. And if you talk to, pick 10 institutional investors and say, would you go buy an office building in Manhattan right now? They'd say no. And if you say, would you go buy a life science deal anywhere? Most of them probably like, yeah, sure, I could get that through committee. So it's just something to watch out for. I mean, they're good fundamentals, no question. It's just a question: is there too much capital in the market chasing, those strategies?
David Roll, do you have any thoughts quickly on this?
The funny thing is that a lot of the life science that has been underway or built actually ends up being leased to tech tenants. So it's life science until there's a high-paying tech tenant coming along, and that's what we've seen.
Yeah. Got it. Great.
One other thing just to say on the prop tech stuff, which I find challenging, is that I'm not a venture capitalist. And I feel like a lot of the times you have to have that hat in addition to be really good at it. And obviously, I'm sure we all try to use our portfolios. And if you see something work, you can make the bet. But there is a binary functionality there, which we're not used to in real estate, where you buy real estate, it doesn't typically go to zero, which you have a risk for in the prop tech.
Right. Good point. Okay, let's move on to the next topic. So over the last decade, commercial real estate players have increasingly considered the environment and sustainability when evaluating investments, partners, and operating properties. But the pandemic has really spurred this, and there's been a rapid growth in ESG adoption. In 2020, we saw public funds, private equity firms, family offices, high net worth investors aggressively increase their ESG commitments. And there's certainly been an acknowledgement of how critical ESG practices play in the future of real estate investment. So Erik, how do you weigh environmental and sustainability factors when evaluating investments, partners, and operating properties? And maybe you can tell us some of the things you're doing at 550 Madison.
Yeah, sure, Chris. I think this matters a lot. I mean, it was on the prior panel. Everybody's talking about it. I'd be utterly shocked to see somebody pitch a new fund if they didn't have an ESG section. And even us, we start thinking about how do we incorporate this into our thinking just to do the right thing, do well by doing good. So, I think for us in 550 Madison, that's a special building to us. It's a LEED Platinum and WELL Gold certified, which one is focused on the building and the other is focused on the people in the building. And it's the only building in the city that can state that, from what I know. So Hudson Yards, One Vanderbilt, I don't know if they reach that level necessarily. And I also think there's something interesting in New York, which maybe we'll see more of, but the most sustainable buildings are ones that already exist. So, we're proud to be like restoring something that's, sort of a historical thing. So the types of things that I think you'll see in a lot of buildings, this included, is the things I mentioned about, air filtration at a very high level, touchless entry, making sure you don't have microbial surfaces, and all these things are like heightened. And I think people have done audits of all their buildings to think about how to be that way, and we've focused on that. And the other unusual thing about that particular building is we added a public garden, which is bigger than MoMA Sculpture Garden, and that's not an everyday thing to do. And I think it's going to help. I'm sure if Marcella is selling a building around there, she's going to be talking about this garden and how it's going to be helping everybody in the neighborhood. So, we're really happy about that, and we think that building will be, something we're proud of for a long time.
Great. David Roll, any thoughts on ESG, how it impacts your investment decisions?
I mean, we've been spending time on kind of the environmental risk for a while with seismic and kind of flooding but now we're also trying to, Norges as a big push, we're trying to move from a paper exercise to actually cutting emissions. And what's very interesting is you can be local, LEED Gold, LEED Platinum, but you're gonna be screwed at the same time in local law 97, so the Climate Mobilization Act in New York City. And these two things do not jive, and it's going to be very interesting how they play out, because there's, my guess is something like LEED, and if they don't adapt, they might become less relevant over time if cities start finding buildings for their carbon emissions per square foot, and we're including that in our underwriting as well. So that's what we're doing.
Thanks, David. Okay, so we're running out of time, so I'm going to move on to the next topic, which is distressed opportunities. So I think a year ago, we all expected a lot of distress to have hit the market by now, but that's just not how it's played out. The rate at which retail hotel loans are moving into foreclosure is far short of the levels the real estate community predicted. That being said, according to CMBS servicer comments, there seems to be a significant pipeline of properties that will go through foreclosure. David Hamm, are you seeing any distress pricing, and where do you expect to see distress in the future?
We had like a 4 to 6 week period back in April where there was a fair amount of distress in the market, and it went away super fast.
Yes.
Yeah, it's we're in an environment where lenders are being accommodating, right? I mean, this is a unique situation. This isn't a real estate driven crisis that we're going through. So I think everyone, including the government, is pushing lenders to be accommodating to borrowers. That will only last for a certain amount of time, but the market's coming back, and it's coming back quickly. So problem assets that are problems today may not be problems tomorrow. I think if you look back to the GFC and when you saw actual distress in the market, it wasn't in 2008 and 2009 from a commercial perspective. It was 2010, 2011 when those opportunities really were available. So I think there's a lag for sure, but I don't think there's going to be much in the way of big distress. I think you might have some need for gap equity on refis and assets that have come down in value marginally, but I don't expect to see a huge wave. Maybe in high street retail, where those rents have really come down. Maybe some select hotels that were not necessarily profitable, pre-pandemic, you could have some issues there. The B mall story, that's going to continue to evolve.
Right.
But I don't expect we're going to see, mass distress across the market at all.
Yeah. Marcella, what are you seeing?
So totally agreed. There was
Mhm.
I think it stopped, but we certainly during a lot of the lockdown got a lot of calls asking what kind of distress was available. On the hotel front, there's still a little bit of it. On other asset classes, debt has certainly bailed out a lot of investors, and any office, owners, particularly in New York, that might have had issues with occupancy, really were helped, because they're wealthy and able to, go through the cycles. So, we'll see what happens, but, New York is really, that's why people buy buildings in New York, because everyone that owns one, is financially capable of weathering a storm. So.
Mhm. Great. Okay, excellent. So we're going to move into the Q&A segment. We did get one question from the audience, so I'll just pose it to all the panelists, and whoever wants to provide a response, please do so. The question is, what do you see for the near-term and long-term future of senior housing?
We're not invested in senior housing, so I have really no opinion or thoughts on senior housing. Demographics sound promising, but I know we've done some, during the pandemic, we actually went and bought some of the public companies.
Yeah, it hasn't been a big initiative of ours. So
Yeah, we watch it, and we've looked at a few things through the years, but I think similar to David, we haven't gone big into that space. We are looking at, the medical side of things generally, though, I think is an interesting space long term. Could be medical office buildings with telehealth or other things like that, but not specifically, buying memory care or other types of senior housing.
Same here. It has been difficult to kind of amass these larger portfolios. So, for us, we've been working a bit on it, from the capital side, but generally it does seem like post-pandemic, it's been, a little bit tougher in terms of some of the different types of care, and occupancy has been a little bit lower, et cetera. So, there's certainly, that's probably an entirely other call to discuss.
Right. All right, excellent. So that's all the time we have. I want to thank the panelists for their invaluable insights. Thank you so much for doing this, and I really enjoyed the conversation, the discussion. I will now turn it to my partner, Lisa Brill, who's going to begin the next and final segment. Thank you all.